It's okay to be scared of what's going on, but you want to be really disciplined about what you do with your money, because the decisions you make today can cost you hundreds and hundreds of thousands of dollars over the long term. I am advising people right now to focus on building a 1-year emergency fund. And that can sound like a lot. A lot of people think, oh, I make $60,000 a year. I need to have $60,000 in my emergency fund. But usually your emergency fund is quite a bit smaller than your actual full income. So you can calculate how much you actually need and you can start saving money. And I would put your investments on pause right now if you don't have that emergency fund. Yes, you may lose a little bit of long-term gains, but I want you to be safe, secure. I want you to have a savings buffer in case the worst happens and you are laid off or let go. In the meantime, I would pay the minimum on the debt that I have. And this can be pretty controversial because some people have interest rates on their debt that's quite high. Well, I just want to pose this question to you. Let's say you focused everything on paying off your debt and then suddenly you're laid off. What are you going to do? You don't have the cash, you don't know what to do, and now your back is against the wall. That's a really bad place to be. The only reason I would recommend you pausing your investment contributions is to take that money and redirect it to an emergency fund. But if you've already got that emergency fund built up, continue investing. Now, what is a basic plan for the average person? A basic plan involves something like a target date fund. A target date fund is just one fund. It's really low cost. It's really simple. All you do is tell them how old you are. And it creates a pie chart for you. And it basically says, when I'm younger, I'm going to be a little bit more aggressive. As I get older, the computer is going to change that pie chart automatically for me and become a little bit more conservative. And that's it. One fund, it's automatically diversified. All you do is send money to it every single month. You don't care if the market has gone down or up because you're not trying to time it. You just care about the money going every single month. That is real investing. And that's the kind of investing that generates huge amounts of returns over the long term. If you have money that you don't need for 10 years plus, that's long-term money. You can put that in the market and safely let it grow. I say long-term because over the short term, it may be volatile, but typically over the long term, that money will continue to return fairly average, fairly good rates. If you need money in a shorter period of time, like you want to go on vacation, you want to put a down payment for a house, etc., that money doesn't go in the market. That money just sits in a high yield savings account. Don't worry so much that your interest rates are lower on your savings account. You don't really make money in a savings account from interest. It doesn't matter if it's 1%, 1.5%. The numbers don't really matter on your interest rate. What matters is simply that your money's safe, it's liquid, and when you need it in 2 years, 3 years, 5 years, you can pull it out right away. So just think step by step: emergency fund, debt and investments, and then investments.